Good afternoon, everyone. Welcome back to Team Armstrong. This is episode number 5. Today we have our special guest back, Sean Larue, helping us out with these ever-changing mortgage options that we have today. So we want to welcome to Sean Larue. Sean, welcome. How are you today?
I'm doing pretty great. Thanks for having me, Blair.
Good to see you, bud.
Good to be seen.
Where are we located today?
Today I'm joining you from the beautiful Scottsdale, Arizona.
There you go.
Yeah.
Any good things happening to you lately? What did you do over the weekend?
There's all kinds of great things happening to me. Over the weekend, I flew out and saw a Chargers game. I saw our butts get kicked by the Cowboys. So it was fun.
Yeah,
it was fun.
That's the worst thing in the world, dude, is to lose to the Cowboys for whatever reason.
Yeah.
I'm a Niner guy, true and true, so that makes it even worse. But now that we have some very close family into the Charger world, it even makes it worse. So I totally hear you.
Yeah, I'll root for anybody other than the Cowboys. But
yeah, for sure, right? Good Lord. So lots of changes again in the mortgage world.
Yeah, there's some good stuff happening.
Why don't you tell us what you kind of give us onto? Because again, what you and I talked about a couple of weeks ago. Talked about how the media is just loving to go ahead and try to scare the beep out of us about what's really going on in this real estate world. And I did something last week while you were out of town too, is just let everybody know that yes, the market is a little bit slower, but people are still buying houses.
Right.
We are in a little bit of a special pocket here compared to everywhere else in the world. Not saying that we're better than anybody else, but it's in a different spot.
Right.
We are a second home mostly. Type of a community. So that makes us just a little bit different. But anyway, with that being said, why don't you kind of share with us the world of mortgages, what's going on right now?
Absolutely.
What are you seeing in your trends?
Sure.
And go from there. And then also we have something to go on here as well.
Great. Yeah.
With a new type of program.
Yeah. So you want me to talk about like the updates in the market and stuff, and then we'll get into the product?
Yeah, why don't you go ahead and just give us little neophytes, really what's going on, what should we be looking for, what's your vibe on the market, all that type of stuff.
Yeah, so I think we're still kind of in the middle of kind of, investors and buyers kind of figuring out what things are worth. I think, we're seeing the same kind of a pullback, but the product I'm going to discuss is a way to show buyers how to minimize their monthly payments today in order to maximize their value on the properties that they're looking for. So there's all kinds of new products being brought into the market. People are still kind of trying to get creative with some things. Interest rates are down compared to where they have been in the past. So that's a really good thing. We're seeing the market come back. But as far as I see listings increasing, the number of listings are increasing, the number of days on market are increasing as well. And I read a statistic, what was it? 8% nationally, 8% of the listings on the market had a price reduction last week. So that's significant. That's significant, right?
Significant.
So, the question I keep getting asked is, are prices coming down? Are values coming down? And to that, I would say, yeah, they might be coming back a little bit off their highs, but, what is it coming down off of? So if we've seen,
Thank you.
So if we've seen 35% appreciation in some pockets over the last 2 years, okay, that 35% profit isn't profit until you sell, right?
Right.
So what are we really talking about here? Yes, values are still up over the last 2 years, but they're just kind of settling down with sellers having realistic expectations, buyers not willing to overpay for something that it's not worth, and, just trying to make the best decisions for your family.
Yeah, I find it, and as we go back to that, I'm glad that you said that, because it seems to kind of be the going trend for us that's actually in this world. And we try to explain to our clients and actually to the rest of the community that's looking to purchase, is that we're not in a crash. We're just in an adjustment. And it's going back to where it was supposed to be. So all of these people thinking that we're going to get 2008 and there's going to be these astronomical great deals and I'm going to wait and I'm going to wait. In the meantime, these interest rates are not going to get any lower. I mean, we're probably going to see another increase here. I would presume so over the next couple of months, if not over the next week compared to what's coming out in the news. But everyone kind of thinks that all of a sudden I'm going to get like $100,000 off, $50,000 off, $60,000 off of these prices. And that may be the case, but it's because they priced at the pinnacle of the market and it's just coming back down to normal.
Yeah. Hey, anybody can get a listing right now. Doesn't mean it's going to sell. Right. So, I mean, we're still seeing a lot of people come on the market with unrealistic list prices. So be cognizant of that. And, it's a good time to make an offer. I don't know if you're going to, I don't know if you're going to get $50,000, $60,000, $70,000 off the price, but it would depend on what price range you're in. And, 10 to 15% on an $800,000 house, you're kind of in there. But on a $400,000, $500,000 house, we're still highly competitive in those markets, I would say. I haven't checked the number of listings, but I know it's still highly competitive and there are not a lot of listings on the market in that price range. But the point is it is a good opportunity. People still need to move. People's lives need to continue. And I think Franklin Loan Center has come out with a really great product to help primary residence buyers, people who are going to be living in the home, and our second home community as well. We have a really great option coming out here shortly with a new product to kind of fill the needs for our buyers who want to have a lower monthly payment today, but are waiting for the market interest rates to come back down.
Okay, let's just share that with you. I'm going to Sean put this together for us, so I want to share this, guys, with you as well.
Yeah.
So help us talk about this.
Yeah. So back in the recession, we had a lot of products, or before the crash, we had these 3-2-1 buy downs. And 3-2-1 buy downs means that we're able to buy down the interest rate for the first year by a certain amount. And so the 3-2-1 means you buy down the interest rate by 3% the first year, 2% the second year, and by 1% of your current note rate today is lowered by 1%. So what we're doing is we're doing a 2-1 buy down. So we don't have the 3-1 option. We'll have that out here shortly. But because we're literally rolling it out, we're only able to do so much, and we're making sure we're in compliance on everything. So let's just throw out some numbers. Let's say our interest rate is 5%. A 2% buy down would give us a 3% note rate today.
Okay.
And then a 4% note rate next year in 12 months after closing. Okay. After the second year, your monthly payments would revert to the qualifying market rate or the note rate that's being offered today. So you get temporary relief. And so, so some of the benefits are it temporarily lowers the monthly payment and saves the buyer money. It allows borrowers to move into their mortgage more gradually. So as people are making more money, businesses are doing better, or through pay raises, maybe they can afford that higher monthly payment in 2 years, but right now it's just a little uncomfortable. The cost of the buy down can be covered up to a certain amount by the seller, and the first 24 months, after the first 24 months of payments have been made, that rate remains fixed. So it's a 30-year fixed product, which is awesome because if rates go up in 2 years, let's say, you're still locked in at, in this example, like a 5% rate. So you're at 3% the first year, 4% the second year, and then 30-year fixed after that. Okay. This loan program works for conventional loans, VA, and FHA. Right now in Riverside County, we don't have high balance in Riverside County, so we don't really need to worry about high balance. But in LA and San Diego, we'll be rolling out those high balance programs soon. This does work for 15-year and a 30-year fixed. So that's really cool. It's not just the 30-year fixed. If you want to get a 15-year fixed payment, you can certainly do that. But obviously for the payment reduction, we'll probably go with the longer term. All right.
Okay.
The contribution can only be paid for by the seller. So we can pay points and buy down an interest rate, and the buyer can do that. But to permanently or do this 2-1 buy down program, all the concessions need to be paid for by the seller. Okay. And
okay, well, I got to stop you real quick on there before we get too far. I understand what you're saying. So how does the seller pay for that? So I'm a buyer. I'm going into this. I want to use this program. How do we structure this? Again, this is just coming from you. Right. I know this answer, but this is explaining to our clients here.
For sure. And
how is the seller paying this down for us to make this beneficial?
That's an awesome leading question. So if you scroll down a little bit on what you got there, let's go to the next one with the little numbers on it.
Right here?
Yeah, the third slide there. And if you can make it a little bigger, I don't know if you can or not, but
how's that?
Oh, that's beautiful. Okay. So with this, the seller's giving us a seller credit to essentially pay for the interest difference on the loan. So for example, in this example, we have a $485,000 loan amount. Okay. A 2% buy down for 12 months on that loan amount reduces the monthly payment to the buyer by $365 a month.
Okay.
Over that first year, that equals $4,380.96. Okay.
Okay.
That's on the right-hand side of this slide on the top two lines. Okay. That's the interest that's being prepaid at closing for the lower interest rate for that year. Okay.
Okay.
Then you calculate the 1% differential for the second year. That saves the buyer $192 a month. And so that amount for the year equals $2,310 for the year. So that means that we're essentially not paying, the buyer's not paying $6,691 of that interest over the first 2 years. And so that's what the seller would credit us.
Got it.
You add those two things up with the interest for those 2 years, and that's the seller credit.
Got it.
Now you can have seller credits for the temporary buy down, but you can also have seller credits to help offset closing costs. But it's going to be a balance, of course, of finding the right offer price, the right amount of closing costs for you, and that contribution. So this is just meant to be like another tool in your tool belt, an option to discuss with your buyers.
Right.
I wouldn't necessarily lead with this, but if a property is slightly out of their reach and you guys are close, this is a good option. And I think I was throwing out numbers like $20,000 or $20,000 price reductions. Mm-hmm. We don't even need to do that in this case. It's less than $10,000. And I mean, for the first year, it'll reduce the monthly payment by $365 a month. I mean, what buyer isn't going to want to take advantage of that or have it make sense to them if it's close to making a deal, right?
So instead of asking, if I'm a buyer going into it, instead of asking like, yeah, I want you to fix this, this, and this on it, and get a buyer's credit on this, actually, this is a way for you to get in, fix it yourself, but get a buyer credit on my loan so I can go ahead and qualify for this loan.
Exactly. Yep.
Yeah. So instead of asking,
and this is going to be good for our primary and second homes, but not great for investors. Okay.
Right. Very, very cool. So just a great, another new option. I love this because it's because usually when we do find a house, we're actually looking for, on the buyer side is they're like, oh gosh, we need to get this fixed. We need this fixed. Well, let's surpass that and, or get past that, excuse me. And,
put your video back on you.
Yeah, putting it right now. Stop sharing on this part, but boy. So
I would say our market now is totally different than it was before. And let me break it down and why. Because, we had a lot of these programs, these adjustable or temporary buy down programs. But the difference in this market today and what we saw in 2008 is that we don't have a lot of the negative amortization features, which means people paying less than the total amount of interest that's accruing every month. We have fewer interest-only loans, which means you're only paying the interest that's due. And we have fewer adjustable rate mortgages that are also going from interest-only payments to a higher interest rate that's also fully amortized. That kind of payment shock just absolutely annihilated our market. And then with all of those adjustments, it was the adjustments in the payments that caused the homeowners to not be able to afford the properties, which caused the cascading waterfall effect, right?
Got it. Yep.
And because of that, that's where the thought of, the lower values came in, because they didn't know where it was going to stop. In this market, the majority of our loans have been underwritten full doc. We've got more equity than we've ever had before in our properties, meaning we're not going to foreclose. We're not going to short sell them. We'll sell them for equity or keep the payments up to date.
Right.
And, did I mention the highest or the best interest rates ever?
Still good, right?
They're still great. So, yeah, people are talking about a pullback in values and prices, but I would say pullback in what? Let's get realistic. And my whole thing is, it's not timing the market. You can never time the market perfectly, but you can have time in the market. And time in the market in real estate over a decent period of time, not a short-term thing, real estate pays off.
Absolutely. Again, I think this takes the scare out of some first-time buyers or maybe some second home buyers, gives some opportunity to take advantage of some discounted rates in a roundabout way. It's not 2008 where we're just going to go ahead and give away money. We're just lowering the rate for a couple of years.
Yeah.
Allows us to go ahead and get through this storm for a little bit. This is what we're in right now. We're doing an adjustment, making sure that our economy can catch up with the inflation portion of that, and hopefully in the next 12 to 18 months, if not sooner, depending on how everything works out with the Fed. So we've got an option to get in and still 3% for a year. It's pretty freaking good.
It's really good.
It's really good.
Yeah.
Sean, I really appreciate you coming out. I know you have more stuff, and we have stuff to come back a little bit later. But thank you for this knowledge. It's some new products out there, stuff that the media is not talking about to get into it. Maybe you've heard about this. Maybe you didn't fully understand it. Any case, when you see this video today, tomorrow, next week, whatever it may be, is always go ahead and reach out to Sean Larue with Franklin Loan Center, located here in the desert, which is another great reason to go ahead and use Franklin Loan Center, because they have the pulse on what's actually going on here. They understand the ebb and flow of the real estate here. So they're not a big bank, but they have big bank rates. So with that being said, Sean, thank you so much for coming out, man. I keep looking to my right because I get to see you on the screen, and I'm looking at my camera over here. So it's kind of like this split camera here. So I appreciate you coming out, man.
Buddy.
Have a good time in Arizona. Man. Look forward to having another conversation, and we'll be in touch with any new stuff that comes out to help our buyers. And actually this really, what you just told us today, really helps our sellers, stuff that might be sitting on the market, where it just opens up to a new can of buyers that probably weren't thinking they could be in the market anymore. So this really does, I'm almost looking at this now as this is really helping out the seller market than it has actually helping out the buyer market.
This is very much evidence that we're shifting to a buyer's market, right? You know,
Yeah.
before
Yeah.
we had sellers getting offers with waived appraisal contingencies, no loan contingencies, and it was just nuts. And now we're looking at structuring product that sellers can offer, not an inducement, but structuring the deal so that it makes sense to the future buyer. So it's awesome.
I love it. All right. To all our Sean Larue Franklin Loan Center followers, we love you. To all your Team Armstrong people, we love you guys too. But most of all, you guys stay safe. Again, most of all, on top of that, God bless, guys. Take care of yourself.